Hi viewers. You are watching Millennium Academy Accounting Hub. Suppose a business purchases $5,000 worth of inventory on credit from a supplier. The journal entry would be: inventory account debit $5,000. Accounts payable account credit $5,000. Impact on financial statements. On balance sheet, inventory asset increases. Accounts payable liability also increases. On income statement, no immediate effect. Suppose received $1,500 cash from a customer for an earlier credit sale. The journal entry will be: cash account debit $1,500. Increases the cash balance. Accounts receivable account credit $1,500. Decreases accounts receivable. Impact on financial statements. On balance sheet, assets. Cash increases by $1,500. Accounts receivable decreases by $1,500. On income statement, no impact because revenue was already recorded at the time of the credit sale. To record the payment of $200 for advertising expense, you can make the following journal entry. Advertising expense account debit $200. Cash or bank account credit $200. Impact on financial statements. On balance sheet, cash asset decreases by $200, reduced liquidity. On income statement, advertising expense increases by $200, reduces net profit, lowering taxable income. The journal entry to record the payment of $800 to a supplier for a previous credit purchase is as follows. Accounts payable debit $800. Cash credit $800. This entry shows that the company is settling its debt, reducing both liabilities accounts payable and assets cash by $800. Impact on the balance sheet. Cash asset decreased by $800. And account payable liability also decreased by $800. Impact on the income statement. No effect because this is a repayment of a liability, not an expense. Impact on the cash flow statement. Operating activities. Cash outflow of $800 is recorded under payments to suppliers. Received $600 in advance for services not yet performed. The journal entry will be: cash account debit $600. Unearned revenue account credit $600. Impact on balance sheet. Assets. Cash increased by $600, received in advance. Liabilities. Unearned revenue increased by $600, a liability until services are performed. Impact on income statement. No effect yet because revenue is not earned, services not performed. Impact on statement of cash flows. Cash from operating activities increased by $600. Accounting entry for paying sales tax. When you remit the collected sales tax to the government, you reduce your sales tax payable liability and record the cash outflow. Suppose ABC Electronics sold goods for $1,000 and collected a 10% sales tax. The customer paid the total amount of $1,100 in cash. Below is the breakdown of the journal entry with explanations for each account movement. The cash account is debited $1,100 to record the increase in cash received. Reason: cash is an asset account, and assets increase with a debit entry. The sales revenue account is credited $1,000 to recognize the income earned from the sale. Reason: revenue accounts increase with a credit under double entry accounting rules. The sales tax payable account is credited $100 because this amount represents the tax collected from the customer. Reason: sales tax payable is a liability account, and liabilities increase with a credit. The cost price of an asset includes all expenses incurred to acquire and prepare it for use. The formula is: cost price equals purchase price plus additional costs. Additional costs may include taxes, shipping and handling, installation and setup, legal fees, modifications, improvements. Example: suppose a machine is purchased for $10,000, pay $500 shipping, and $300 installation. The cost price of the machine is $10,800. Sold goods costing $1,000 for $1,500 will increase the owner's equity by: cost of goods sold $1,000. Sales revenue $1,500. Gross profit is the difference between the sales revenue and the cost of goods sold. The gross profit is $500, which increases the owner's equity, because it represents the net gain from the sale. If salaries paid during the year is $1,200 and prepaid salaries is $100, then the amount debited to income and expenditure account will be. The actual salary expense for the current year is calculated as salary expense equals salaries paid minus prepaid. This $1,100 is the amount that should be debited to the income and expenditure account. A cash book has separate columns for bank and cash transactions. On the 1st of March, the balance in the cash account was $200. Transactions during March were: cash bank $30, check drawn for cash $70. What is the balance on the cash account at the end of March? Transaction A: cash account credited $30 with reference to the bank account. Transaction B: cash account debited $70 with reference to the bank. The closing balance of cash is $240.
If you like a video, then please subscribe to our channel and press bell icon for regular updates.